And I think that's the question that we're all grappling with right now. But I think it's also important to take a step back and look at what's really driving the market volatility. And I think it's a combination of really three things. It's, of course, the uncertainty that we're acutely aware of at this point as it relates to the Fed's aggressive rate hiking path, the war in Ukraine, disruption of global supply chains in China. But we're also seeing dynamics around leverage, around liquidity that I think are really exacerbating the market moves that we're seeing. So in leverage, especially those managers that are more growth oriented, we're seeing some forced unwinds, and I think that's compounding some of the losses. And then when it comes to liquidity, liquidity is low across virtually all asset classes. And I think that's really exacerbating the market moves that we're seeing right now in response. I think it's too soon to say whether we're looking at a bottom, so to speak, right now. I think the market is downtrodden, but I don't think we're at recessionary levels. But what I would say is that sentiment is incredibly bearish right now. And when we look at how sentiment at these levels tracks into forward-looking returns on a historical basis, typically when sentiment is this bearish, forward returns 3 months out tend to be positive.
Yeah, interesting that you make the argument that you don't think that we'll see global recession here. And yet 2 weeks ago, we had US GDP down 1.4% for the first quarter. Madison, even as we saw that print, we heard the Federal Reserve constantly telling us that we're going to have further 50 basis point rate hikes. Is that not going to damage demand even further?
Sure. I think that's a great question. I do think Fed policy is having its intended effect in removing some of the pressure and slowing things down. They want to take some of that demand, which goes back to the conversation you were having a little bit earlier on that demand-driven inflation that we're seeing. So they have to quell some demand. And we're seeing this most acutely already in the housing sector. New 30-year mortgage rates have skyrocketed. They're at 5.5%. That's the widest relative to existing mortgage rates on record. And that's really meaningful considering that the housing market is the most cyclical part of the U.S. economy. 65% of Americans own a home. And that tells us that the Fed is already doing its job. But what that also tells us is that the forward trajectory for interest rates from here might be capped as you have that negative economic feedback loop. And as interest rates start to head lower, in response to that, you can start to step into those quality areas of the market that can protect during periods of time such as these.
Madison, good morning to you. If I look at a Cape valuation, this market's still overvalued, isn't it?
So I think valuations are really interesting right now. Over 80% of S&P 500 companies are currently in correction territory or down 10% from their 52-week highs. And I actually think valuations look quite reasonable. The S&P 500's at 16.9 times currently. That's below the 5-year average. That's back in line with the 10-year average. I would say that we're buyers of the dip here, but we do expect some volatility along the way. So I would say valuations, to answer your question, are more in line with average than we have seen in the past few years.